So I just want to give you guys just a quick update of some things that have been happening over the last couple weeks that really could affect the market, both from a real estate standpoint and just from a market standpoint in general, as far as everyday living for you guys with consumer pricing and inflation. So also with my channel, I got to ask you for the favor, help me triple D this video and channel. So what we need you to do is just help define this video by smashing that like button. It just lets people know this is good content and there's some good information out there. And then if you can, help develop this channel just by subscribing. It doesn't cost you anything. Hit the subscribe button, hit the little bell notification. You'll get notified of new videos that come out and just some market information as I discover it and it comes out. I'll post it on new videos and let you guys know. And then of course, help me deliver this video just by sharing it with someone who you think might benefit from the information. And best of all, like I said, this doesn't cost you anything, it's free, and that's a double D on your triple D. So let's get into this video. Welcome back to my channel, Costa Living, and today we're going to talk about something that is the tipping point of some of the stuff that's happened in the housing market. And we want to point out any new changes or anything that's going to affect the housing market and kind of give us some insight of the direction of where things are going. And one of the biggest things to happen in the last couple weeks, if you haven't heard already, is Wells Fargo is freezing and canceling all of their credit lines. And what impact is this going to have on the housing market? Basically, it's the drying up of money. So if you remember, we kind of covered this subject matter pretty thoroughly in the video for the housing market. Is the housing market going to crash in 2021 or 2022? I'll put that link to that video right up here. If you haven't checked it out, I'd highly encourage you to check it out because we go kind of in detail of just the supply and the demand channel, and that essentially is what freezing of these assets is going to do. So there's a couple things that this leads us to. One is it's mainly just for their lines of credit, their HELOCs. They're still doing new mortgages and new loans, refinances. They're just freezing up all their lines of credit. So it has kind of a couple effects. One is it's really freezing up people's buying power. And so when you're freezing up people's buying power, the effect of that is you're going to basically slow down the supply of money. And as you saw from before with our supply and the demand curve, when you slow down the supply of money, you are going to have some deflationary consequences. So that can actually be a good thing. If people don't have the money to go out and buy stuff, then it lowers the cost of goods. If you don't have the demand, you don't have the price comes down. So we kind of covered that before, either the supply and the demand feature. So as far as the housing market is concerned, we talk about supply, and that's going to be the forbearances and the foreclosures that might be coming on, and that's going to increase the supply. When that supply comes in, then it's going to decrease the price. But we have such a high demand right now that's going to be kind of consumed with that. So I don't think we're going to see necessarily a drop in price because of the forbearances. But where we do have an issue now is when we start seeing the supply of money being dried up. So, when you have the demand for product, the demand for houses, as I told you before, the one big key factor there is interest rates. And so interest rates is going to affect the demand for the product. And then also, if they start freezing and not allowing credit to go through, if you can't get the loans and you start drying up the supply of money, that's going to have the same effect. It's going to decrease the demand. So you either increase the cost of getting the funds if they change the interest rate. So if they change the interest rate and the interest rates go up, it's going to be more expensive to get the money, which is going to decrease the demand. And then you also have the issue where if they just dry up the supply of the money and you can't get the loans, well, that's also going to drive demand because you can't get the loans. So that's how it could possibly affect the housing market. Now, this is just Wells Fargo, and Wells Fargo can kind of be repositioning, but they've always been a very large player in the home market industry. So the fact that they're getting rid of HELOCs as well, that's kind of concerning. And so, something to watch for you guys out there is you want to watch what other banks are going to do. So if we start seeing this trend and we see other banks kind of following suit, that can be a big red flag. So if that's going to happen and that supply of money starts drying up, we could see kind of a correction in the market. And again, this is also going to be for inflationary purposes, because now people will have the extra money to go buy additional products, and that's typically what these lines of credits and loans were for. They're not necessarily to buy a house, because it's a HELOC, it's a line of credit. So you don't have the amount of funds to go buy a house, but you do have the funds to go on vacation, go buy cars, do some short-term investments to maybe improve your house. So the type of funds that were used for that is now being dried up and canceled. You're going to see a reduction in spending. So you want to watch that. And kind of the next thing to follow through with this, with the drying up of the supply of money, is you want to start watching what the other banks are going to do, but also what the other credit cards are going to do. And so we kind of saw this in 2008, 2009, and when the big crash started to happen, is everybody started to pull back. And so you're going to see, if you have perhaps credit cards out there with high limits, $20,000, $30,000 credit limits, you might see, if you're not utilizing them, they're going to start getting cut back. Again, the banks are trying to reduce their risk of what's out there. So that's kind of a scary thing. So if you start seeing your credit cards being reduced, or perhaps credit cards that you're not using, if you start getting letters that going, you haven't used your credit card in 2 years, so we're going to just cancel your credit card. Again, these are signs. I'm not saying this is happening yet, but I'm trying to give you guys the things to look for. So if you start seeing some of this stuff, red flag should go up. So again, I encourage you guys to go out there, lock in your rates now while you can. Enjoy these low interest rates. Don't know if they'll ever be this low again. And there's a couple things that this does too. I mean, I'm talking about this from the housing market standpoint, but this is also a huge impact on the consumer side. So, I wouldn't be too sure if the government has some kind of hand in this, because what happens is you're decreasing the supply of money. So as I told you before, we're going to have inflation. Inflation is coming because of the printing of the money. And as I told you before, when you have that increase in supply, you have more money coming into the market, the value of that money gets less. So the value of the dollar is going down. And so when the value of the dollar goes down, it takes more of those dollars to buy goods. And we've seen that kind of with the increased cost of just employment. You look at the jobs that are out there, they're going way up. Our local Taco Bell is I keep using that as an example just because it's easy and everybody knows what Taco Bell is. They're paying $17 an hour starting wage. They're paying bonuses to come and sign on. That's unheard of. So when you have what used to be these starter jobs now paying $17 an hour, that's going to translate into higher cost of goods. You can't go to Taco Bell and get a 99-cent taco anymore because they're paying $17 an hour for the guy to make your taco. And then we have the cost of fuel. The cost of fuel continues to go up because we canceled the pipeline. And so when those costs go up of transferring goods back and forth across the country, it's going to raise consumer pricing. So inflation is coming. It's going to come. But by drying up the supply of money, that is one way that the government can kind of combat inflation without really raising interest rates. Because if there's no money to go out and buy goods, the cost of those goods will come down. So this is a deflationary measure. Now this is Wells Fargo doing this, but again, this could be effect on the whole QE and the repo and reverse repo of the government funds. Again, that's kind of really advanced topics for this, for this channel. If you want to learn more about that, I suggest go check out George Hammond's videos. He's got some great videos on it. He goes really in depth if you kind of want to get in the weeds. Very knowledgeable and just a great channel. But again, more advanced topics. So it's kind of over the top. This is kind of more of a basic channel for beginners. Some of the things they should have taught you in school. So again, if we see this trend continuing, these are deflationary measures that are happening. So this could be a way to kind of deflate some of the inflation without really affecting interest rates, to still allow those that are capable of to go out and qualify for loans and to still purchase homes. But it is a red flag. I mean, it's one of the red flags. Keep an eye on other banks, see if they're going to follow. Keep an eye out on credit cards and see what's going to happen there. If they start decreasing credit lines and start closing credit cards, again, just more signs. Now, again, I haven't seen those other signs. This could just be an issue for Wells Fargo, but we want to let you be aware of the situation. I got a letter from one of my other banks that's increasing HELOCs. They're making it easy. They were doing some things with that they were paying for the loans, not for the loans, but for the fees and cost of opening a HELOC. So while Wells Fargo may be closing and canceling theirs, there's other banks that are kind of hoping to capture on some of that market share. I've been a Wells Fargo customer for 30 years. I was originally with First Interstate Bank, back in the late 80s and early 90s. It was my first bank I opened. And Wells Fargo bought out First Interstate Bank in the early 90s, and so my account just transferred to Wells Fargo. So I've been with them for a long time. And I got to tell you, the last couple years, Wells Fargo has really, to me, has just gone downhill exponentially. This is just my personal opinion and some of the stuff that I've experienced. I know even like our local branch here, they closed the branch with COVID, which I understand a lot of local banks did, but they never opened back up. Everything is still there, and they can open up, but every bank around them is opened up. So I bank at all the other banks around there, and they're still open. And I called and asked about our specific bank, and they said, well, it's a branch manager decision. And so the branch manager decided not to keep it open. And I've known some other comments from other YouTubers, because I kind of made this comment on some other videos that I watch, and people are making the same comments. I had two branches close in my town, and they haven't opened up either. So I don't know what the long-term thing is going on with Wells Fargo, but there's some issues that I have with the way that they're doing business. So I'm going to personally be transitioning some of my business away from Wells Fargo just for that reason. I think they're going the wrong way. But that's just me personally, and it's not advice. This is, you guys do what you want to do. But anyway, just wanted to give you this information and let you know kind of my thoughts on the Wells Fargo closing credit lines, tightening up the loan restrictions, kind of what effect that might have on the housing market, and the red flag that's being raised. You want to keep an eye on these things, and hopefully it's not a trend going on to other banks, but it can eventually affect the markets. So keep an eye out there, and I'll keep you guys updated as well. If I hear of more banks closing, drop a comment down below. Let me know if you have other banks that are doing the same thing, or any other information there. This is a community. Let's help each other out, and drop some comments down below. I will reply to them. I read all the comments, and let's build this channel together. So with that in mind, don't forget to smash that like button, and also subscribe. I would appreciate if you subscribe. So we'll catch you next time and give you the next update when we get one.